Good morning. It's Wednesday, the 21st of August, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital, but right now in transit. The take. There is the disease and there's the symptom. The disease is that auto sales are most likely slowing down, and the symptom is rising inventories with car dealers. Now, the question is the disease spreading beyond car sales, or are car sales the disease itself? There is another symptom of the problem of slow sales, which is that more discounts and schemes are being offered, particularly on older models of cars, while new models and hybrids are doing well, including with waiting periods. Now, this is not the first time this is happening, which is that older models are selling less and customers are itching for newer ones. But what is happening for the first time is that car inventories with dealerships have hit a record high at over 2 months and stock worth over 73,000 crore rupees. All of this has brought out disagreements between dealers and manufacturers wide into the open. Not a common occurrence, which also reflects that things are definitely worse than what they appear. Now, auto sales are obviously a leading indicator on how consumption is playing out, as it is on the health of the economy as a whole. The Federation of Automobile Dealers Associations, whose president Manish Rajsinghania I spoke to earlier this week, says their members are carrying stock equivalent to over 2 months of sales, that is about 730,000 units. An Economic Times article quotes car companies saying that actually it's half of that, or around 400,000 units. Now, this is actually a very big gap between 400,000 and 700,000, and obviously means each faction is accusing the other of some pretty big lies. Now, FADA, FADA, says it's written to the Society of Indian Automobile Manufacturers twice in less than 2 months, protesting at stock being dumped on dealers. But to be fair to FADA, they've been pointing out high inventories on the core report itself for several months now. So it's not a surprise, at least to me. The Economic Times article also says that car sales in India, also the world's third largest market, fell for the first time in more than 2 years in July, as sluggish demand led to an inventory glut at dealerships, forcing car makers to curtail dispatches, counted its sales to their channels. Sales have declined about 2.5% year-on-year to 341,000 units during the month. Now, that decline might appear small, and perhaps it is, but it's a trend reversal in a seemingly strong market, which is, of course, worrying. The Economic Times also quotes rating agency CRISIL saying it's revised its growth forecast for the domestic passenger vehicle market to lower single digits from 4 to 6% predicted earlier. FADA also put out an appeal to banks saying they should be careful about lending to auto dealerships, in a way asking that banks check their own members from over-leveraging. So a considerable part of the stock held by dealers is financed by banks. Car makers, including the big ones, are acknowledging inventories are high, but claim it's lower than what the dealers are saying. And most of them seem to be saying that their inventories with dealers are a little over a month, while dealers, of course, are saying it's more than 2 months. Car makers are also questioning the total outstanding finance and say it's closer to about 45,000 crores and not the 73,000 crore rupees the dealerships say. Perhaps the answer lies in between. But FADA is saying its counting is accurate and it's not relenting, at least for now. So there is a larger, and again not new, problem, which is that in the interest of auto companies to show high sales, because many of them like Maruti, Tata Motors and Mahindra & Mahindra are listed companies, they would perhaps move stock into dealerships. Obviously, all of this also reflects a sign of weakness which will hit stock prices. Actually, that's already happening. A Bloomberg report says a sizzling rally in India's auto shares is reversing as a buildup of unsold vehicles and growing discounts by car makers pressure profit margins. India's NSE Nifty Auto Index was down about 4% in August, more than double the decline in the Nifty 50. Maruti Suzuki, considered a bellwether, has fallen about 6%, on track for its worst monthly performance since December 2022. So the larger question is this: are the post-pandemic sales euphoria now disappearing or going away? Now, this is also a larger question because sectors like travel and hospitality are already seeing the first signs of post-pandemic euphoria fading, particularly in the Western markets. Could this be happening in India too, and therefore things coming to a more level rate of consumption? India is at the cusp of the festival season, which will last for several weeks into Diwali, a period that usually sees higher sales of all products, particularly items in luxury. Maybe car sales will rebound to higher levels thanks to newer models, but the question is definitely hovering over us. Whether cars or other products and services, will the growth momentum continue? And on to the top themes and stories for the day. Markets piggyback on Wall Street rise. IT stocks could keep momentum high. Oil prices slide on reports of peace talks in the Middle East. Are Indians switching to loans against gold because regular loans are becoming tougher to get?
This is the Core Report with Govindraj Ethiraj.
Markets ride on Wall Street. Yesterday, we spoke of a revival in the fortunes of information technology stocks riding on increased spends by their key customers in the Western markets, particularly the banking and financial services space in countries like the United States. Banks in the United States are now all gearing up to spend more this year on IT, including newer disciplines like artificial intelligence. If spending goes up, as it looks like it will, then it's good news for Indian IT services companies. Moreover, if banks and insurance companies start spending, others could follow, kicking off a sort of longer virtuous cycle of IT spend. Now, the benchmark indices ended on a 2-week high and the highest closing since August 2nd, thanks to the perception that fortunes for IT stocks are changing for the better, and finance stocks have done well too. The Sensex ended at 80,803 levels on Tuesday, up 378 points. NSE Nifty 50 closed at 24,698, up 126 points. The broader markets, which include the BSE mid-cap and small-cap indices, also did well, closing between 1 and 0.5% higher. The rupee has regained some energy. It strengthened against the US dollar after several weeks of staying under pressure to close at about 83 rupees 79 paise to $1. Global stocks have, of course, resumed their big march, gaining steam after the recovery following the lows hit earlier this month. All of this is on the expectation that the Federal Reserve will start cutting rates soon. CNBC said that all major groups in the S&P 500 rose on Monday, though it was steady on Tuesday. But on Monday, the gauge was up for the 8th straight day, the longest winning streak since November. The general feeling and bet is that the gains will extend beyond the tech space. And some good news on crude following reports of that ceasefire talks between Hamas and Israel are gaining steam. Brent crude is now under $78 a barrel at about $77.74. If there is a ceasefire, prices may slip a little more, but the larger question is really demand and supply forces that are playing out, including with manufacturers who are constantly trying to manage production and output to keep prices high. Gold prices. For the first time ever, a bar of gold is worth a cool $1 million, a milestone that was reached last week when gold's spot price crossed $2,500 per troy ounce, an all-time high according to Bloomberg. The calculation works like this. With gold bars typically weighing about 400 ounces, that would make each one more than $1 million. There are some nuances to the figure, says Bloomberg, because the amount of pure gold could be less in a bar. Be that as it may, in the first half of this year, central bank net purchases of gold stood at about 483 tons, equivalent to about 40,000 bars. That includes India, by the way. And this is according to a Bloomberg calculation using figures from consultancy Metals Focus. Just to remind you, gold is rising in this manner because of expectations that the Federal Reserve will cut rates, and it has risen 21% from year to date, making it the best performing major commodity in 2024, says Bloomberg. Of course, it's not without reason we talk about it frequently on the core report. And the outlook continues to be bright, by the way, going by all the leading commodity strategists who are now talking about $2,700 per ounce. More on gold coming up in a moment. Gold loans are dropping. Many Indians might be switching to taking loans against gold because they're unable to get unsecured loans thanks to the Reserve Bank of India and banks tightening the screws here, including by raising risk weightages. Now, this seems likely because gold loans dispersals have shot up despite this tighter lending regime. Gold loans are often taken by small businesses and many more, or rather more likely, sole proprietorships to bridge short-term cash requirements. Other reasons, of course, include education and festive occasions. Most loans, by the way, that is taken against gold are returned within the year. Another stipulation in May saying gold loan NBFCs or non-bank finance companies could not disperse cash in excess of 20,000 rupees, which, by the way, was the mode most borrowers preferred, also does not seem to have had much impact. Some 95% of dispersals were in cash, says a note from CRISIL Ratings. I reached out to Ajit Velonie, Senior Director at CRISIL Ratings. I began by asking him what was the impact of this new regime on gold loans and why they were still growing in the manner they were.
May this year was really an important moment for the industry. Largely, the gold loan industry works where borrower is able to come to the branch and able to get the gold at a very short notice, quick turnaround time. And the industry has worked where you have dispersed the money in terms of cash because most of these borrowers need the money for an immediate requirement. The way the gold loans are structured too, you typically find there is full flexibility in terms of the repayment. So mostly it's a bullet repayment. Tenor of the gold loan can be anywhere from, say, 3 months for your players follow going all the way up to 12 months. But typically you'll find that the repayments happen within, say, 5 to 6 months. And the cash disbursement is a very important part because the borrower wants the money quickly. Now, in May of this year, what happened is that the regulator sent an advisory. This is based on an interpretation of the Income Tax Act. And the provisions of the Act effectively do not allow an individual to receive money beyond 20,000 rupees in cash. So that had an impact for the players. And we had, in fact, put out an advisory saying this could potentially impact the business of all gold loan NBFCs. And what we did as part of this analysis is we quickly looked at what was the actual business done in the month of June. That's a month after the advisory. And what we noted is that the industry actually adapted to the regulation very well, very quickly. And the disbursements done in the June were about 12% higher than what was done on an average, say, for Jan, Feb, and March for this year. So overall, to say that the industry had adapted to regulatory development very quickly and it was business as usual.
Right. And what is that figure per month? And I understand that you're now rating NBFCs which represent more than 90% of the industry. So therefore, you would represent most of the industry.
So on an average for the month of Jan, Feb, and March, it was about 29,000 crores was the average disbursements. And in the month of June, that is the month after, it was nearly about 32,500. So that represents about 12%. Of course, one part caveat to say is one of the leading NBFCs is currently undergoing RBI embargo. That entity could not disburse any amount, in the month of June. So if you actually exclude that entity on a like-to-like basis, the growth is even higher. It's about 23% as growth. Might add that, gold prices have also played an important role here because ultimately this business works on a loan to value. And we have seen gold price, hit new highs in the month of June. And what we saw is commensurate. We did see some increase in the ticket sizes too. And that allowed the industry to show this growth.
Right. And you're saying that most loans are paid back within 5 to 6 months?
Yeah. So if you analyze it from a cohort of disbursements, what you typically see is that if an entity disburses 100 rupees, say in the month of January, within 6 months by the end of Jan, about 65% of the money is actually fully paid off. The industry also works in the system that the amount to be paid, the interest is typically accrued and the principal is meant to be a bullet payment. So let's say you have a 12-month loan, you will only need to pay it on the 12th month. But if you do pay earlier, the industry also looks to incentivize the borrower with some element of rebate on the interest. And the borrowers here typically need money for a short notice. So the way the industry works is you typically have a borrower coming in, he may use the money for about, say, 2 months, 3 months, and probably comes back after 2 weeks for, taking another round of money. But it's just more of a very fast, quick turnaround money that the industry is able to provide.
And would you have a number on how this stacks up against all consumer loans, secured and unsecured? This, I'm assuming, is secured.
So when you look at the industry, the two biggest segments for the industry are housing loans and vehicle finance. So they will constitute more than 50% of the industry. So if I take, say, the non-banking financial sector NBFC, our estimate is the sector AUM is about 28 odd lakh crore. In that background, the gold loan industry is about 1.65 lakh crore.
Okay, so it's a very small percentage of the overall.
That's right, yeah.
Right. Okay. And we've also seen gold prices come down after the government reduced customs duties in July from 15 to 6%. So is that having any impact on the value of gold?
Yeah, I think what we have seen with gold loan NBFCs at least is they're typically very much focused on risk management practices. And there are 2-3 key areas which they focus on. One, as I was mentioning to you, the product is bullet repayment product. Now, the interest is also not really due, it's typically accrued. But what the industry does is they encourage the borrowers to keep paying interest on a periodic basis so that the loan to value is typically kept under control. The second element is that they do track the gold prices very, very closely. And what you will find is that the LTV or the loan to value is actually fixed literally on a daily basis. So when you do see a sharp increase in the prices, you may find that the NBFC prices the LTV differently. And when there's a sharp fall, they may build in an additional cushion. So the ultimate reflection of this is in the portfolio loan to value. And what we have seen is that the portfolio loan to value has remained between 60 to 65%. Now, against this, the regulatory upper limit is 75%. So there is enough cushion, even assuming that there is a sharp fall in price, to be able to manage in terms of risk on the portfolio. The other element I would say is auctions. So the way the industry also works is they monitor the loan to value very, very closely. And in case there is a breach of this margin, they typically send a notice for the auction. Historically, we have seen that when it comes to the principal value, the losses have a range annualized between 0.2 to 0.5% only. So the industry has seen very negligible losses, largely because of very high emphasis and focus on these risk management practices.
Right. If I can come back to the question that we started with, what explains the jump that you've seen in the last month? Because you said that one player is not active now And despite that, there's a more than 12% increase. But if you take away that player, it's actually a much larger increase.
So there are two elements we have seen historically for the gold loan business. There is clearly a correlation of growth with gold price, because if that value of the gold has gone up, the borrower is able to come in and he realizes he's able to get more from a loan to value perspective. We also think that this period of April to June, there was other developments from the industry point of view. As you would be aware, Govindraj, that there was an increase in the risk weights on consumer credit. And I think we have seen that play out in the sector overall, both for NBFCs and banks, that there is an element of risk being built in when it comes to lending on the unsecured loan side. So we do think some element of the increase that we are seeing in the gold loans could also be because of the fact that unsecured loans are maybe not as easily available as they were earlier. So a combination of gold price improvement as well as some risk off that you see on the unsecured has really helped the industry show good growth. So our estimate for the growth in the AUM, what we gave you earlier was disbursement, is about 10%. That is non-annualized. So an absolute growth of about 10% is what we have seen for the industry between March and June. So that's compares to, let's say, last year, the whole year, the growth was about 20%. And if you go to the previous year, it was about, say, 10 to 11%.
So you're saying that the increase in risk weights is actually having an impact, and which is why people need the money. So they're therefore saying, okay, now I'm not getting the loan, like a consumer loan, just like that. So now let me go and put my gold down and then take a loan instead.
At an overall systemic level, yes, we do believe that from an access to funding, if you're not able to access the unsecured loans, a gold loans is a very, very fast, quick mean of being able to get the money at a shorter notice. And that is clearly will help the.
Gold loans are a more regional phenomenon. As I understand, it's more in the south of India. And secondly, do you have a sense on what people mostly take these loans for? I got the fact that it's mostly short duration and people are returning. But do you have any idea why they take it or what could be the driving factors?
The industry is largely built itself in the south. In south, people are well aware about. But we have seen for the larger players that they have managed to expand very well, even in the north region. So I would say both regions are showing good growth. In terms of the end use, mostly the customers here coming in for supporting from the business. So you do have a short-term working capital requirement for purchase. We've also seen end use being typically for, say, a medical treatment or for education-related purpose. I think these would be the top 3-4 reasons that we see from an end use point.
But you're saying it's for business, which means that people are putting personal, let's say, savings or assets down to fund their business. And I presume those businesses are also small.
Yeah, these are typically smaller, you will say, kirana shops or vendors, etc., who will need the money to be done, who need the money at a very, very from a shorter tenure point.
Right. Ajit, thank you so much for joining me.
Thanks so much, Govindraj, for having me here.
The chip war continues. We've been pointing out in the core report that there is a global chip war on, fueled by subsidies from the richest countries in the world, making it tougher for less rich countries like India to match those subsidies to set up manufacturing facilities, though we have set up 3. The latest country to jump into chip manufacturing is Germany, and Taiwan Semiconductor Manufacturing has reportedly broken ground in eastern Germany on its first European plant. Chips, by the way, are viewed as strategic assets which countries, including India, want to control the manufacturing of, more so after COVID when the supply chains had failed. German Chancellor Olaf Scholz said that they were dependent on semiconductors for our sustainable future technologies, and they must not be dependent on other regions of the world for supply of semiconductors, he said in a report quoted by Bloomberg. Significantly, about half the funding will be covered by state subsidies. Germany, by the way, is leading the European Union push to produce 1/5 of the world's semiconductors by 2030, which is 6 years from now. Germany says it will spend about 20 billion euros to bolster domestic chip production. That includes the TSMC plant that we've spoken of and another $10 billion in aid for a planned Intel Corporation plant in another part of Germany. The new site will help Europe reduce its reliance on Asia for importing vital technology and comes, as Bloomberg says, after German car makers including Volkswagen and Porsche expressed interest in boosting domestic chip production, and production is expected to start by end of 2027. India has 3 chip-making and assembling plants in various stages of construction and readiness, of which at least one should start producing in 2 years' time. India will be making the older, higher nanometer chips used for basic electronics, including automobiles and electronic goods, as opposed to the more latest ones that go into the more newer iPhones. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.